Hi, everyone. Thanks so much for joining. We have an awesome panel today on the state of early stage investing for first-time founders, which should be super interesting. We'll be leaving plenty of time at the end for questions. If you would like to ask a question, please feel free to take yourself off mute or put your question in the chat. And just a reminder to please turn your cameras on for the duration of the session. Patrick Chung is our moderator today. Patrick's the managing general partner of X Fund and also holds a JD MBA from HBS and HLS. Patrick is going to get us started today. So thanks, Patrick. I'll turn it over to you.
Terrific, Emily. Thank you so much. And Ben, thank you for the invitation. Everyone, happy summer. Hope you're having a great time. So just by a quick way of introduction, I'm Patrick Chung from X Fund. X Fund is the early stage venture capital firm that was co-founded by two of the world's most successful venture firms, Accel and NEA, in partnership with Harvard University. Before this, I was for many years the head of the consumer investing practice at NEA, and then founded and managed the seed stage investing practice of NEA, from which we spun out X Fund. And we are a fund that is specifically designed to back people just like you out of the world's very best universities. In 95% of all cases, X Fund is the very first investor in the companies we invest in, about 40% consumer, 40% enterprise, 20% digital health. And we have an office right on campus at Harvard and also in Palo Alto, California, which is where I normally am. So really pleased to meet all of you. We have a phenomenal panel today, and I'm going to ask each of them, perhaps we could go Henri, Mehda, and then Nimi, to do a quick sub 60-second intro, and then we'll delve right in. And then, as Emily says, we'll have plenty of time for questions because we really want to basically be as helpful as we can to the fellows and to talk about what you guys want to talk about. So, Henri, can I start with you?
Yeah, Henri Pierre-Jacques. I was HBS 2019. Currently live in Miami. Used to be in New York. Prior to HBS, did investment banking and private equity. Started Harlem Capital 2016, and then raised the fund my second year of business school at Harvard.
Terrific. Mehda?
Awesome. Hey guys, I'm Mehda. I was HBS 2016. Am a partner at Redpoint, focused on early stage investing, which for us is seed and Series A primarily. Before my venture career, was a founder, and before that started my career in consulting.
Fantastic. And then last but not least, Nimi.
Hey everyone, my name is Nimi. I was HBS class of 2015, and I'm a partner at Box Group. We are an early stage fund. I'm based in New York, so we're a team of 7 investors. 6 of us are here in New York, and we have 1 partner out in San Francisco. And we focus on early stage companies and founders. We're often participating in the first institutional capital round that a founder is raising. So whether that's friends and family or seed round, we're very generalist. So we spend time across a bunch of spaces. And yeah, really excited to chat with you all. Prior to venture, I worked at Google and started my career in more traditional finance at JP Morgan.
All right, fantastic. So thank you all the panelists for being here and taking an hour out of your summer for us. The Rock Summer Fellows are working hard on starting businesses and working on projects. And so panelists, I'll go to you and ask, if you were a first-time founder, like one of these people on the Zoom today, who was pitching yourself, what are the elements of a pitch that would most increase that founder's chances of success with you? So who would like to start with that?
I can start. I think it obviously varies. I think first component is like getting to the pitch. So like having a really succinct deck. The introduction definitely matters. You know, last year we saw probably 4,000 deals and took meetings with roughly 500 or 600 of the companies. So like making sure you get the right introduction. We do take calls with our pitch form online. I think once you actually do get the pitch, a big part of it is energy and belief in yourself and belief in the business. You know, I think modern day VC definitely has leaned more towards people who are kind of outgoing extroverts, which isn't necessarily always the best founder or CEO, but it is a bias that I've seen for a lot of VCs. And so making sure you bring the energy, people can feel that you're passionate about the business. Because really what they're trying to figure out is, can you convince the next investor at the Series A or Series B to get capital? Can you convince your first 5 or 7 employees to leave Facebook or whatever companies? Can you convince early customers to become beta customers when you really have no business at that point, right? And so like that energy, that emotional that you feel is really about how do you make others feel who are going to be critical to building your business. And so don't underestimate the storytelling component as much as the TAM, the market, and all the other, nuances that you have to have in your deck.
Just out of curiosity, Henri, are you taking first pitches these days by Zoom or in person? And I'll ask the same with Nimi and Meta.
Zoom, it was pre-COVID, same post-COVID. I mean, we've invested in 13 cities across the US, though New York, SF, LA, and Miami are, 80% of the fund, but other 20% are across the country. So Zoom is always our first meeting. I mean, even for a deal, I would say probably like 20 or 25% of companies we invest in, maybe we meet the founder before, but like it's not a requisite for us.
Okay, great. Okay, Meta, what would be necessary for success for you? And also, if you do it by Zoom, how do you convey that type of excitement and passion when you've literally been reduced to 2 dimensions on this thing?
Yeah, good question. Okay, I'll start with the first one. I think the best advice I can give is just be prepared. Like so much of, you'd be surprised how many pitches we get, which are where it's clear this is the founder's first meeting. This might be the first time they're telling their story. And you get a lot better at anything you practice. And so, putting a lot of thought into your deck, practicing the pitch, making sure it fits in the 30-minute Zoom window that we're talking about so that you can get through all the points you want to hit, I think is really important and makes a big difference. And I think my advice is use a deck. I think there are very few people that are able to follow a story arc completely verbally. I think when you have a deck, you control the narrative, and many well-intentioned investors, including myself, will, start throwing questions at you out of interest and excitement, and it can help, and it'll veer the conversation in different directions, maybe in ways that veer away from the main points that you want to hit that best highlight your company. And I think a deck allows you to constantly go back to those main points that you want to get across. So my advice is to always use a deck whenever you can. And then on to the point on, over-indexing potentially on extroversion. I think there is a narrative in tech that the pitch matters more, can matter more than execution. And I don't know if that's true, but the reason why at least I overweight a pitch, and I think many of my peers do as well, is really an early stage founder's job is to be a salesperson. Like you have to convince investors to believe in you ahead of there being very much product or traction. You have to convince early stage people, ideally amazing potential employees, to join you before that too. And it's kind of an irrational decision on their part. And so it takes a lot of visionary thought, convincing a really compelling individual, and then customers to invest in you early. Your first few design partners, they're investing with you, either consumers or businesses ahead of, it's probably not a great use of their time, right? Like if they waited 6 months or a year, you'd have a fully baked product and they could sign up then and not deal with the back and forth and the bugs and things like that. And so I really do think that pitching in a convincing way is one in limited interactions before having to make a decision, is one way for investors to get insight into, are you going to be a great salesperson in all those respects in the early days? And that's kind of the lens through which I'm sitting in every meeting thinking, hey, would I want to work for this person? Would I want to sign up to be an early user of the product based on what they're telling me? And then on the Zoom piece, I would say I take most of my first meetings on Zoom. I think there can be a host of reasons. Maybe I knew the person before, or they're coming in from out of town, or, that I'll take the meeting in person. But usually I think even founders, I'm finding, want to do the first meeting on Zoom just because it's more efficient. And I think it is a little bit harder, but I think energy can very easily be conveyed across the screen, especially if you've practiced before. I think, you can kind of keep to the cadence that you've rehearsed with people and the feedback you've gotten. So I don't actually think it's that much of a detriment, but yeah, I'd be interested if others disagree.
Okay, Nimi, what do you think? What would it take to be successful in a pitch with Nimi?
Well, I echo a lot of what was said by Henri and Maida. Yeah, I mean, I think that, one of the things that I think sometimes founders are surprised at is that, in my opinion, I think both the seed and the Series A are still very much vision pitches. So it's really about telling a story, being convincing, and sharing your vision for the company. I think similar to what Maida was saying, one of like the things that we're thinking about as we meet a company is just, why are you the person, why are you the team to work on this and be the winner? And so what is it about your team backgrounds? What is it about your unique insight on the market? What is it about, maybe the product vision? And so I think, if you have that sort of question in the back of your mind, it's really about, telling a really compelling vision and story. And I think that continues, honestly, even at the A. Like, certainly you have more traction in a product you can show, but you're still really painting the arc of the future. And so I would just lean into that as you think about putting together your deck and as you think about approaching that conversation. I do think that like having a deck, sending it beforehand, I believe helps sort of everybody come to the conversation more prepared. And it allows you to potentially have more of like a dynamic conversation with an investor. For me, I find those the most effective over Zooms, one where there is like a back and forth dialogue versus just like a straight pitch. And so I think that's like the benefit of sending things in advance and allowing the person on the other side to be more of a prepared mind. And yet, for us, like we've been doing sort of remote and Zoom pitches for many years now. So it's like not a totally new behavior. I think that Zoom can be pretty high fidelity. I think that it can be like time effective on both sides, especially for a first conversation. And hopefully allows you to almost get through even more material. So yeah, I almost think that like Zoom is part of our new world and we just all have to learn to be effective at it.
And to the deck point briefly, highly recommend you send the deck ahead of time. We hate the YC approach of not sending decks. It does good. It's a waste of both our time and your time. We can't ask the questions. We haven't done any diligence. And so now you're wasting 20 minutes just updating me on what I could read on a deck before. So I know some accelerators push that, but not effective for a lot of investors. And most of my investor friends hate when founders don't send decks ahead of pitch calls.
Henri, I'm glad you brought that up. Let's like double click on that for a sec. I think the reason why, just to play advocacy, an advocacy role for the fellows here, part of the reason I think YC counsels its founders to do that, because I agree with you, Henri, I detest it as well, is because they don't want the investor to get a deck to form initial, perhaps, dismissive impressions of the company, and then simply not take the meeting or not pay attention or just flip through and kind of, if you're, it's kind of like going to see a Broadway show and, someone sending you the script and the music and a recording all at once. It kind of loses the magic of the first time. And so do you actually think it's bad for the founder not to do that? Or do you think it's actually just like people like us, the investors, don't like it because we don't like it?
I think it's bad for both sides. But I think it's different if you've already gotten the email back and forth and it's like, hey, I'm going to talk to you in 2 days. If you send the investor the deck and the investor cancels the call because they reviewed the deck, then you probably don't want them as your investor anyway, right? So like, what's the risk to that? Like you kind of just saved yourself 30 minutes. I think ultimately, whether you're an investor or founder, like time is your most valuable asset, right? We see thousands of decks a year, and so we have a pretty tight funnel. And founders, whether you're in Demo Day or not, are going to have dozens of pitches, and so you want to make sure you're spending your time wisely with people. And then when you have 30 minutes with somebody, which is very quick, you want to make sure you extract the most amount of value from that investor, whether or not they invest or they can ask you questions or push you for things to use in the future. I mean, for us, if we didn't send our deck before our LP pitches, it'd just be a waste of 45 minutes. We want to, it's no different for VCs. I'm not going to go into an LP pitch about an LP reviewing my deck. I don't have the capacity or time to talk to LP just because they're interested in the fund because they've seen our brand. Like I want to talk to LP to actually understand, hey, we're early stage, we're on our third fund. This is our check size range. Like, is this of interest to you? If that's the case, let's spend time talking. Like if we're in completely different worlds and we're just talking just because you're afraid I'm going to say no before we have a conversation, like that's to me a waste of my time. I think time is just too valuable for founders and VCs. And if you can remove that, you're mostly better served. Occasionally, yes, you'll have a diamond in the rough where maybe you lost one VC because of it. But I think ultimately 99% of the time, you're going to be better positioned by having people review your deck ahead of time.
Okay, good. Well, I'm going to kind of pop it out to the prospective founders in the audience, the fellows. Do any of you feel strongly, do any of you want to do any of you feel like it actually works better not to send a deck and force the investor to hear the show de novo for the first time? If not, we will move on. But if one of you feels strongly on this, I think this is a very common tension between investors and founders. Going once, going twice. All right.
Well, Lapita asked a question in
sorry.
the chat. I mean, so I like, you don't have to send your full deck, right? So I do agree with that. Like some people will send a 10 to 12 page deck, ahead of time. And then when they get to the call, they've got the long appendix. And if the investor is actually interested, then post the call, they'll send the 20, 30 page deck because they, to some extent have more trust in that VC actually having interest versus having all your information out there with VCs who could share with competitors potentially. So, sending a deck ahead of time doesn't mean you send the full length deck that has the appendix. It could be a shortened version of the deck, just typically not, the 1 to 2 page YC deck that they consider.
And actually, just my 2 cents, my answer to that question would depend on the stage of the company. At the seed stage, I think later stages, maybe even Series A, I think it's the top. I would say investors fall on different sides of this. And I think it really depends on the company. But at the seed, I do think generally it's better to send the deck ahead of time, especially if you've made some progress that's really impressive. There have been certain instances where I've gotten a blurb on a company and it's in a competitive space where I've met a handful of folks before and I'm inclined to pass. And then I open the deck and there's a few like design partner logos that are really impressive, or the team's background is incredibly impressive. And I actually take the meeting when I wasn't going to otherwise. And so, to what Henri was saying, it could, cause the investor to pass, but it also could convince them. If you have a great deck or have made a bunch of interesting progress, it could push someone over the edge to actually take the meeting. So I think it's nuanced, but generally at seed, I would suggest sending in advance.
Great. And for our part at X Fund, we will spend the time with you no matter what. And so whether you send a deck to us or you don't, you will get the time. So on to the next. One of the most common questions that we get when we speak with in groups like this is founders ask, well, what is the minimum stuff that I need to have in order to actually walk through the investor's door and do a pitch? Do I have to be at a certain state with a product, with market traction, with revenues? Do you guys have any real minimum benchmarks before they walk through the door, or can they literally walk through the door? I'm a first year RC at HBS. I got no product, I got no team, but I'm really, really good. Give me walking around money. So what is the minimum standard that you will accept to take before you'll invest? So Nimi, perhaps we can start with you.
Yeah, I can speak for us specifically, but we're open to having very early conversations. We like to say that we like to be the first conversation. So with some folks, that might be that they are even still at their company, they just left their company, and they're interested in a space and they want to spend time with us informally talking about different ideas and options. For others, that might be like they have an idea, but not a co-founder, and they're figuring out what to do. I think for us, like, we're very open to investing anywhere on the early stage spectrum, which means that the minimum bar for us is low. Now, the only caveat that I would say to that is, like, I think generally there's probably, for successful fundraisers, there's like a little bit of an inverse correlation between like experience, whether that's like prior, like you've started a company before, or like, let's say you've been at like a high growth tech company for 5+ years. I think that the more of that you have, the almost like more latitude you have to have a bunch of those conversations early, and they might be successful and lead to like some sort of early funding round. I think obviously, if you have less of that, then almost the expectation or burden of proof is higher. So I think that's just like a dynamic to be cognizant of. And look, I think that like, just like people classically give the advice for like job interviews or things, I think every conversation with an investor is some sort of like data point, right? Like, if we think about investors forming a line as like an impression of a founder, every meeting, every touch point is a dot along that curve. And so, even if you are brainstorming, I think that you want to put your best foot forward. You want to show like some level of market expertise or thoughtfulness. Like, even when we have these early ideation conversations, sometimes I think about, what's the progress been between the last meeting 2 months ago and the conversation that we're having now? And if it feels like we're almost having the same conversation, we're probably less excited. So I think it's important that if you are going to have those early touch points, that you do, approach them with that in mind.
That's such a good point, Nimi. A lot of founders kind of labor under the impression they can have a kind of informational interview or a kind of a get to know you type of thing, which they don't believe is evaluative. But as Nimi points out, we're all human, and even a casual coffee is going to be evaluative. And if you don't make a good impression in that casual coffee, when you're ready to pitch with your deck and everything, they may decide not to take the meeting. Or Henri, do you guys have minimum standards before people come to pitch you of any kind of traction or benchmark that you're looking for?
No, so 50% of our deals are pre-rev, 50% are post-rev. I would say what we tell our founders is like, it's not, I can't like quantify it, but like qualitatively, there is kind of like this death trap of, call it $1 to like 10K MRR, right? There is benefits to being pre-revenue because people are betting on the founder and the TAM, right? And you're seeing that now with AI. You saw it with Web3. You saw it with consumer fintech 2-3 years ago. I think, and once you're kind of in that like 0 to 100K ARR range, you don't really have enough data to tell me any story. You probably haven't had your customers for a full, 12-month cycle for me to see any sort of like net dollar retention or cohort analysis, et cetera. Right. And so like what I would consider to be like true seed is kind of like this 100K ARR to 350, 400K ARR. And when you're kind of like sub 100K ARR and you're raising a seed, there's typically going to be a lot of questions focused on data. And that generally, at least from what we've seen, is not the best position as a founder. Like you're typically best, you can usually raise a $3 to $5 million round easier if you're just in a hot market and you're a good founder for background versus you trying to push back and forth on, this is why I lost this customer, or this is why our growth rate was 8% this month, whatever it may be. And so like we have told a lot of our founders, like, either go out on the market pre-revenue or like try to get 100K plus ARR. So you at least have some real traction. At that point, you probably had at least 5 to 10 design partners or alpha beta partners that you could actually have do customer reference calls. And so just be mindful of that. I wouldn't say like we've, proven that. It's just what we've seen across our 55 portfolio companies. And so there are pros and cons to having traction, right? And you need to be aware of that. And the same is true for fund managers, right? They say fund 2 is the easiest fund to raise for a reason, right? And as you get more funds, you've got more data. And so you've got more things to prove. And the same is true for founders. Like more data is good if the data looks good and you can tell a story. So it can also cause problems.
Very good. Maida, do you have anything to add or?
No, I think people covered it.
Okay, very good. If we were to have had this session perhaps maybe a year or two ago, I think we were in a time of relative ebullience. How have things changed since the market correction? Has the bar gone up for founders? And in what ways has the bar gone up? And most importantly, what can the fellows do to clear that bar? Nimi?
Yeah, I mean, I would say, I think we've observed like the bar has definitely gone up. I think it's gone up at seed and Series A. Hard to quantify it exactly, but it just feels like across the board, the bar is higher. I think that, probably the biggest change that I feel like I've observed in the seed market is during the frothy period of, 2020, 2021, most founders who had a great pitch were able to raise $3 to $5 million. And so you had very little of, if you want to call them pre-seed rounds, earlier rounds, those used to exist, but I think generally in the froth, those went away because everyone was able to just raise more capital. We're definitely seeing that change, and we see a lot more founders now raising that earlier $1 to $2 million round as somewhat of a proof of concept. So I think that that's back. There's hopefully an opportunity for folks to consider raising that amount if it feels like the right fit. I think you're still going to have some founders who can just command the pull in the market to raise 3 to 5, but that's probably the biggest structural shift that I think we've seen in the seed market, in the past kind of year and a half. And so, yeah, I think the bar across the board is higher. And so I think that just means all these things that we're touching on, that you're working through them, that you're preparing for them, that you're going into it eyes wide open. I think, the other thing is you're probably casting a wider net of investors as well. I think that's, again, certainly happening at the Series A, going to more investors, and also just anticipating that things might take longer. It might be generally a longer process than what you expect for getting a full group together.
Very, very wise. Mehdi or Henri, any advice in this new normal world? No? Okay.
Yeah, I was just looking for a tweet I did because Nemi literally hit on exactly what I was gonna say, which I posted before. I'd actually thought the pre-seeds were to just go away because they just didn't exist, to her point. And now, even this year we've done 5 deals, 3 of them were pre-seeds because those founders who are raising $1 to $2 million rounds would have been raising 3 to 5. And essentially what was called seed in 2021 were pre-seed risks that people were just giving them more capital. Right. So I think the terminology kind of nowadays just doesn't mean a lot. We typically, for us, we say pre-seed is sub 3 million, seed is kind of 3 to 6, and then Series A is 6+. The stages just don't matter anymore because somebody can raise 3 to 5 million, call it a seed, even though they're pre-product, pre-rev. I mean, the bar has definitely gone up. I'd say the bar has probably gone up the least at the seed stage, and by far the most at Series B, Series C, or pre-IPO. And so there is a higher bar for the seed because the Series A, has gone from, call it 1 million ARR to, I would say most people I talk to are now 2 to 2.5 million ARR. Order to raise the Series A, right? Unit economics obviously matter now because people are focused on burn metrics and profitability later stage. So those things are more. I think another big thing is before, people fundamentally had a belief that we can just back great founders, and I think that is still true. But I think more and more VCs are realizing that markets do matter. And you kind of had a period where it was a full-on, we're going to bet the jockey versus the race. I think that is coming back to reality where, to some extent, whether it's consumer fintech or consumer goods, you had the Allbirds, the WeWorks, the Caspers of the world, where a lot of people were just these aren't venture companies, or even the Thrazios, where you're doing Amazon brand, buy-ups, which essentially to me is private equity. This isn't venture capital, we're buying brands. And so And we had a time period where a lot of people were calling things venture capital and just backing really smart people. And we could tell our LPs, hey, look at this person's resume. We're backing them really smart. But I think now we're getting back to the reality, like venture capital is called venture for a reason. You have to be able to get operating leverage as you scale. If your business doesn't expand margins with more scale, then you're not a true tech software business, right? And so, there will always kind of continue to be VCs that invest in, probably like non-traditional venture backable companies. But I do think more and more early stage investors and later stage investors are kind of going back to the traditional roots of what venture capital is really meant to be, and you no longer can just back really smart people in every single space. That's been a big lesson for us as an early second fund, but I'm seeing that more across the board for a lot of our peers, which means that a lot of smart people who would have got backed in 21 doing something maybe off rails are probably going to have a much harder time raising capital, even though they went to Harvard or Stanford or whatever school.
Well, that's a good point. And Nimi, you also brought it up about how in this new world, we have to founders will have to enlarge their circle of the types of investors, the number of investors they're pursuing. And so what other types of investors, where would you advise they go outside of venture? What are the best sources of initial funding for a first-time founder, if not people like us? early stage seed investors?
I,
Meta.
yeah, in terms of funding, I would even take a step back and really decide what kind of business do you want to build? Like, do you want to take funding at all? And then the question is, what kind of funding? But maybe you don't. There's I feel like in tech, there's this, a lifestyle business or bootstrap business is sometimes perceived of as less than, but I would actually argue those are amazing businesses. Like, you own 100% of your company, and maybe instead of growing 10x a year, you're growing 5x or 2x or whatever it is, but you own 100% of it, and you could cash flow it out to yourself. When you hit some sort of scale, when you sell it, you get all the proceeds. You get to decide what growth rate you want to grow at. You can be faster one year, slower another year. I think once you decide you want to take funding, it's a decision that I'm on this journey with other people who might have different outcomes that they need for it to be interesting. And so I do think I think sometimes founders, particularly over the last couple of years, just defaulted to venture or fundraising as the option. I would really encourage you to be thoughtful about deciding to go on that journey with outside investors, and then to make a decision of, do you want to just take friends and family, or do you want to go down the venture path? And I think when you go down the venture path, the reality is that you're signing up for hyper growth. Your investors are going to push you to do what's best for the business, but once you raise venture, the expectation is you keep raising venture, and in order to do that, you need to have hyper growth and scale, and the size of the outcomes to make it interesting are different, right? Like, if I were to personally get a couple $1 million, $5 million, $10 million exit, if I owned a business, that would be life-changing for me. But as a partner at Redpoint, one of my companies returning $5 or $10 million is not a good outcome, right? One of my companies returning $200 million is not a great outcome, actually, because we have a pretty large fund. And so when we think about each swing that we're taking, we have a lot of money and less time than money. And so when we allocate time to a deal, we're really trying to take the biggest swings. We want to invest in the Stripes, Twilios, Zendesk, Lookers of the world, which have gone on to be multi-billion-dollar outcomes. And that's not a good thing or a bad thing. It's just different. And I think just being thoughtful about which journey you want to be on, and being really realistic to what Henri was saying earlier. If you're a D2C business, is venture the right path, or is slower, thoughtful growth because you're building a physical product, making sure your unit economics and your BOM are under control before opening the floodgates on acquisition is the right path, is a really important conversation to have with your co-founders if you have them, but also with yourself.
All right, very good. The last most common question we are asked before we turn it over to the audience for questions is, how does a first-time founder think of how much to raise? How do they think about sizing that first slug of equity? Who's got a good heuristic for us? Nimi, you are nodding your head enthusiastically.
Other to go for. I mean, I think my general heuristic is like, I think that financing at this stage is milestone financing. So I think that you're trying to think about what do you need to back into to raise the next round, and then adding some cushion to that. So, if the goal of this round is to firm up the idea, build a product, get your first few customers, and get to 1 million of ARR, I think you're figuring out what's the team size you need for that. You should factor in extra time, assuming everything isn't going to go perfectly. So I think that that's one version of just how to think about the right general round size. I think that I think that one thing that's important to calibrate, even between sort of the pre-seed and the seed round sizes that we were chatting about, is just expectations are different also for given how much capital you raise. So if you raise $4 million, the expectation of what you're able to achieve on that is very different from if you raise $750K or $1 million. So I think that's worth considering, just, which one feels like most appropriate for the business today. And then the last thing I would say is, to some extent, while you can sort of do your own bottoms up analysis, there's also an element of just like market supply and demand. And so if you're very effective and you're able to command more than you maybe originally thought at terms that you're excited about, then that changes it. And you may decide to pursue that, that path. And the inverse is true as well. And maybe you end up revising your plan too. So I think there's probably like a range, that makes sense.
Yeah, I would
And
just say
on that,
go ahead.
I totally agree with that approach, Nimi, which is you find out what state your company's got to be in a great position to raise the next round, and you budget it out. How much does that cost your people, your rent, etc. And then whatever that number is, I would add as Nimi said, a buffer, but I would add at least 50% buffer to that. Things always take longer than you expect them to. Things always cost more than you expect them to. And the worst position on earth to be in is when you've promised your investors with this first slug of, whatever, $1 million, $500,000 I'm going to get here. And you come back and you say, your $1 million is gone. I'm nowhere near there. Can I have more money, please? They'll either shut you down right there and then, or it'll be highly punitive. When you add the 50% buffer, you're increasing the chances that you'll go back and say, I promised you I'd get here. I'm 2x there. In which case, that's a totally different conversation, a more positive one, obviously. Henri, I'm sorry. Go ahead.
Yeah, and I was looking for a blog post that Charles Hudson did, which I just posted. So I mean, Charles at Precursor probably done more pre-seeds than 99% of funds. And so for pre-seed, what he's found that for his successful companies, the average burn is 60K for companies that actually graduate. And I would say for most of our companies, it's 50 to 70K for pre-seed. So you kind of, what we typically bottom up approach is like, we never invest in a company with less than 24 months runway, right? So pre-seed, if you're assuming 50 to 70K, that's roughly $1.5 to $2 million. For our seed companies, our average burn across portfolio has been 120 to 150K. So that's kind of $3 to $5 million, right? So typically, which is why we say like, hey, to us, seed is 3 million plus, pre-seed is 1 to 2, because that's kind of what you need from a burn perspective in order to hit the 24-month milestone. I would say from a top-down approach, to Nimi's point, like the market does matter as well, right? Because if you're now in a market where you can't raise a $3 to $5 million pre-seed round, which you would have called a seed before, that round will now be actually 1 to 2. And so it's a bottom-up approach, and you have to kind of realize, like, are you in a hot sector? If you obviously have any sort of AI and you're coming from Harvard Business School and you had some sort of product or investing background before HBS, like you're probably going to be able to raise 3 to 5 million still. It's kind of the new Web3. Right. And so if you're not in that space, or you're kind of in a market, which we're seeing now for consumer fintech, where we have companies that are still growing wildly fast month over month, but like every consumer fintech investor got burned and nobody wants to touch with a 10-foot pole, you're probably going to raise half what you could have raised, 2 years ago, even if you have a great background, just because that market's out of favor. Right. And so you do have to understand like what market, what sector you're in, even if you have a great background. Like if you're in an out of favor market, if you're in Web3 right now, I mean, there's a lot of funds that aren't investing in Web3 outside of Andreessen and a couple others. You need to be aware of that. Right. And so I think it's just a reality. But I think from a bottom up approach, we never invest in companies that have less than 24 months runway based on like what we would say is like average burn. It's obviously different if you're in hardware or you're in biotech, but like for 90% of companies, these burn ranges are typically pretty, steady across the board.
Very
The
good.
only
Okay.
thing
Yep. Go ahead.
Go ahead.
No, I was just going to open it up for questions. So if
Okay,
maybe
the only other thing I would add is I could not agree more with the add 50% buffer to however much you think it'll take to hit the milestones. The other input to that equation is, what are the milestones you're trying to achieve, right? For some companies, sometimes they come to me and say, I want to raise 3 to 5, or I want to raise 10. And given the market they're in, like all the dynamics, it's hard to point to one specific factor. It feels unlikely that they're going to be able to raise that much. And sometimes teams are really insistent, like, I need that amount of money to hit the next milestone. My feedback is always, is that the right milestone? Like, should you be more realistic about, hey, what is the way investors think about fundraising, and I encourage founders to as well, is every fundraise is a time when you de-risk something about the business. And so what are all the different points that you want to de-risk? Maybe the first is there even a market here, or can I build this product? And the next one is, can I figure out how to get customers? For every business, it's a little bit different, but what is the MVP that you need to achieve to hit that de-risking point? I would really consider you to like get to the bare bones of what that looks like, because maybe the answer is you need to raise more, but maybe the answer is you need to rethink, the breadth of the team and the product and the progress that you need to make, and you could do it in a more lean way.
Very good. That wise words. Okay, who's got questions? It would be lovely if you could, take yourself off mute and we could hear your voice and you could vocalize your own question. But if you're too shy, chat us. Oh yes, Christian, go ahead.
Hi guys, thank you so much. I have a question because one of my areas that I'm focused on is in clean tech, and I've always had this struggle with trying to understand what's the right amount to raise for this project that I'm working on, in which we're building a very large and big hardware, and our business model isn't to sell it. So we want to raise the money and then go to market and make the money from the energy. So that would require a very large amount of fundraise, and we don't want to have a large debt to equity issue, but the ratio. So long story short, is that even realistic to ask? Let's say, for first round to try to raise, let's say 40 to 50 million. If you can get that, of course, if we can get that money back pretty quickly once the project is off ground, or is it just out of the question? You should do it by milestone based, and maybe like build some hardware and get those going, and then raise another round to get that going.
Okay, who would like to take that one? The sequencing of a giant round first, or a series of smaller rounds, pros and cons.
It's realistic.
I know absolutely nothing about clean tech, so I can't give great advice. I mean, I think raising 40 million for any first round, no matter what you're doing, is going to be harder, right? Unless you're probably Elon Musk going to the government for $1 billion. So I just have to be realistic, try to find people in the industry who've done it before. I'm sure like in clean tech, it's probably more common than traditional, venture. Obviously, it's not common for traditional venture to raise a $40 million round unless you're Adam Newman and you raise 350 for your pre-seed round.
Well,
but
also all of
the bar is very
biopharma.
high.
I mean, biopharma operates that way because you've just got a lot of
Yeah, you have to. So there's going to be particular investors
early on. Yeah.
But not something we've seen personally.
Okay, Ben, did you have a question, or did you want to?
Thanks, Patrick. So mine was pretty much the same question, a little bit less high on that, but still, just if you're in a relatively tough tech thing where you're not going to have revenue until you're able, like the goods that I guess your COGS is going to be a couple $100,000 for each test case. So you realistically need considerably more than $1 million at this point. Just how you'd recommend going about that, but it sounds like really just look for investors.
I think Maida actually gave the best answer to this question, which is you want to, what I would do, Ben, if you have something that's, because obviously the reason you wouldn't do that is you don't want to dilute so much initially. And so what I would do is actually go out to your prospective next round investors and ask them, hey, what is the intermediate value creating milestone that you would like to see me get to for me to raise the next 5 million, and talk to many of them so you get some sort of consensus. And then you can just raise that 5 million instead of the 20 million. And when you get to that 5 million, your valuation will go up, and then you do it again. And you ask, okay, what is the next mini step that I'll get to? And so long as you are kind of maintaining kind of lockstep with the expectations of future investors, and many of them, so you want to triangulate about it, I think you can execute that kind of, series of smaller rounds instead of one ginormous round, which has a much higher activation energy to begin with and attendantly much higher dilution. Kristen, go ahead.
Hello, great to meet all of you, and thanks for chatting with us. My name is Kristen. This summer I'm building in the women's health space, but my question for you all is, for the founders who transitioned into VC, can you describe that transition and what are your POVs? I feel like there's different schools of thought on whether, VCs should be founders first, and kind of whether or not that's not necessarily a requirement, but do you feel like that makes you a better VC?
Okay, so Henri, Nimi, Maida, which of you were founders before this?
I was, so I'm happy to start and others feel free to jump in. There were a lot of questions in there, so tell me if I miss one of them. I personally believe that being a founder has made me a better investor because I have more empathy for the founder journey. But I don't think that it's a prerequisite in any way to be an investor. If you look at the Midas list, the top 10 Midas list winners all have different backgrounds, different approaches. And so I think venture is an amazing, just like tech, an amazing industry because it allows success through so many different paths. And you kind of can be your own person and follow your whatever passions you have. And as long as you do those things, I think there's a possibility to be successful. So I think it was a good path for me, but even if you look at my team, the Midas list, whatever it is, there's some really, really incredible, successful folks that have all sorts of backgrounds. And then on top of that, I would say, based on the stage you're investing in, my answer also changes a little bit. I think if you're doing extremely late stage investing, the toolkit and the strengths that you need look really different than what Nimi, Henri, and I are doing. And so I don't know what stage you're interested in joining, but based on that, I think the answer can vary as well.
Very good. I think, and Kristen, for my part, I think the difference between a founder and investor is very different. It's just like Maida says, I analogize them to being an artist and an art dealer. The art dealer doesn't have to be able to pick up a paintbrush and know how to paint. The art dealer has to be able to look at a painter and say, your paintings are phenomenal. I'm going to make you famous. I'm going to get your galleries. I'm going to get you into galleries and sell your paintings. And if you're successful, I'm successful. But they're actually two different skills. And I think while there's some sort of real empathy in a founder investor, a prior founder being an investor, the downside to that is that many prior founders often feel like, I know how to do this. You should listen to me. I was successful. Let me just lay down the law to you. You've never done this before. Trust me. And that type of high-handed behavior is kind of what gives venture people a lot of bad reputations often.
Yeah, I can quickly give the investor side. I mean, so it's funny, when I was at HBS and we were raising the fund, that was like one of our fundamental questions for Fund One, right? We never worked in venture. We weren't operators. I think ultimately what I've seen in our belief is that it doesn't really matter. The empathy piece is interesting. I think it matters less for GPs because if you raise your own fund, you are a founder. So it's a little bit different for GPs probably than investors. But I think ultimately into the game for early stage, it's an emotional roller coaster, an emotional decision where you're choosing people to be some sort of coach, therapist, yada, yada. And oftentimes founders are choosing us because of that emotional connection. I think the last 10 years have kind of gone, partially because of Andreessen, we've swung to the founder piece. We've also swung to the value add platforms. And a lot of these value add platforms are now getting entrenched and people are getting fired because people are kind of realizing they over bloated, what the platform teams were into value add. But ultimately, there's a lot of different ways to make money. You can be very hands-on, very hands-off like Founders Fund, very hands-on like Sequoia. And so I think just follow whatever path you want. I think too many try to point to one investor and say this is the right approach. And I always find it really, coming in from the outside, weird that people said that to be a venture capitalist, you need to be a founder. Because I looked at all of the legends who I looked up to who were investors, never were operators, right? Robert Smith, Henry Kravis, Steve Schwartzman, multi-billionaires who created, massive investment industries, never were operators in their own right. And, even Warren Buffett, to some extent, he started a newspaper and a couple other things. But I never thought that venture capital was unique compared to every other investing class. And in other investing classes, some of the best investors in the world were never operators. And so to me, that gave me comfort that I know it can be done, right? So I think choose your own path. Don't try to listen to, one or two people, figure out whatever your specialty is or your superpower and lean into that superpower. That's all you can really do. You can't try to adjust your superpower to compete with somebody else. You'll always lose that battle.
Ruben, go ahead.
Thanks. I'm currently building in the education sector. I have a question about the process from your side when you're deciding to invest in a company or not. From the first initial point of getting an introduction, receiving a pitch deck or something, up to the point where you sign a check? Like, what are the key points where you in that journey where you decide yes or no, and then how many of them are there?
Okay.
I mean,
Nimi,
I think that question probably varies by fund, and so it'll be different for every firm you're talking to. You know, there will be a different process. You know, I can speak to our process, but generally, yeah, I mean, generally there's sort of like a few touch points along the way. Like, we first hear about you and the company, and we maybe have some materials to review, and so we make a preliminary decision of, do we want to take a meeting? And then usually some group of us, either people who have spent time in this space, someone who's interested, if there's somebody who knows you or has a connection to you, they join for that conversation. So it could be anywhere from 1 to 4 of us. And then for our process, we have two meetings every week as a full team. So we talk about our full pipeline in that meeting. And so, you know, your company will be one of the things that we touch on. And we make sure that before that, everybody has, you know, the deck or whatever information we have a conversation as a group. And there's sort of then a second decision of, do we want to spend more time on this? And that's where we'll end up, you know, scheduling then second, maybe even third conversations to dig in to, areas where we have questions. If we haven't met your co-founder, maybe we'll meet your co-founder, dive into the product. We'll probably be doing like our own separate diligence and references along the way. But for us, it's usually 2 or 3 conversations, and we're able to get to a decision. I would say that process generally takes like a few weeks. But, you know, again, I think timing is one of those things where if there's a forcing function and a catalyst, it can always be faster than that too. But that's sort of like a little bit of a window into our process, if that's helpful.
Yeah, I'd say for us, our average first call to term sheet is 14 days. Typical funnel, like if we get 100 decks, I would say we probably take 20 calls. 20 calls, we probably do 5 memos. Of the 5 memos, we probably go to 3 partner meetings, and then we invest in 1, right? So even less to, you know, because we have a 0.5% investment rate, so actually be 0.5 versus the 1. So it's a pretty tight funnel, but like really once you get to kind of the partner stage for us, it's typically 50-50 chance, no different than HBS interview process, that we would invest or at least give an offer and, you know, try to win the deal. And similar, I would say probably on average, it's like 3 calls. So initial call with 1 partner, follow-up call, and then partner meeting. And then there's a bunch of like references in between with customers and personal references, etc. in that 2-week period. And, you know, our fastest deal has been 24 hours. Our longest deal has been multiple months, right? Depends on kind of supply demand and how long it's taken. But like kind of average is 2 weeks, and usually that 125 one from a funnel perspective.
all right, Malay, you got the last question. Shoot.
So I mean, HBS tends to have a lot of investors come to campus. So I'm just curious for each of you guys, like, what is the unique kind of insight that you guys have in investors that separate you from like maybe the rest of the people that we tend to see at HBS? So I guess that's a good last question.
All order. What are your edges, everyone? Why are you better than Mike Moritz? Go ahead. Go ahead, Henri. Prove it.
Like I'm pitching LP. Yeah, I mean, I think every venture firm's different, right? For us, like we are a mission-driven fund, so like our goal is to invest in people of color and women. It's 96% of the portfolio for us is Black, Latino, or women of color. Right, and we're early stage, and we really pride ourselves on building an incredible brand. We've been around for 4 years and have a lot of people kind of around the table, and so like we have a lot of network and access. I think every VC will give their value add spiel, like, hey, I can do this platform, that, yada, yada. But I think ultimately our belief is like, you have to want us before we're in the room, especially in the 2021-20 era where people are giving term sheets in 48 hours. Like if you were trying to fight and prove to people, hey, I can add this value, and I just met you 2 days ago, you're probably going to lose that deal, right? So for us, like we're really big on making sure we tell our story and tell the brand before we meet you so we can win that deal and make sure you have an emotional connection to us. Like for us, that is kind of doing a lot of posts on social media, making sure we get value add back to the community. We share all of our memos, so the 5 memos we do, even if we pass on you, we give all those memos to the founders that we passed on, right? And we kind of build goodwill in the community. We've got a lot of deals from past founders who share stuff with us because they see our memos and say, hey, they actually did a lot of work. we think could be beneficial to you. So for us, it just really is building a great brand, being good humans. I think through that, we've just built a really strong network, and we are fortunate to have a lot of strong people around us. And, you know, I would say the last piece is like the diverse founder community. If you're a diverse founder, oftentimes you're a unicorn. I was the only Black person in my entire 45-person banking group. You're kind of used to that. And so with our founders of 55, like they are all unicorns together. And so I think they find a really great community together, which is pretty rare versus a lot of other funds. Like you may be the only one, I think, which is fine. I was the only one for most of my life. But you kind of get annoyed of that, right? So I think there's a powerful benefit to the founders to not being the only one. You know, hopefully for the thing that you want to do for the rest of your life, you want to share that moment with others. So.
Very good. Nimi, you want to go next?
Yeah, sure. You know, for us, we've been doing this for 13 years and we've always been focused on the early stage. So I think our biggest differentiator is that this is our craft. We love the 0 to 1 part of the company journey. And so that's our sweet spot. Our model is predicated on, we actually write a very collaborative check. So we're an and, not an or, to invest alongside a Sequoia, an Excel, you know, a first round capital. We're very intentional about our business model and our product because we really believe in the power law of venture. And so we want to be able to have access to and invest in the best companies. And then, you know, I would say that for us, we, at this point, you know, unintentionally have probably backed into having one of the most scaled portfolios outside of YC. And so we find that companies like Ramp and Airtable and a bunch of others, you know, find that it's a very unique and helpful early distribution channel. But the last thing is, like, again, I think it all gets back to our business model. We like to be the friend in the room more than the parent in the room. And we think that that allows us to build a very unique relationship with founders that's different from their board member. And I think the best thing that we can do is like build our brand organically. I think as Box Group has grown, we find that, you know, so often we'll talk to somebody on Zoom and they'll be like, you know, you actually invested in my roommate or a friend of mine. And if we can just keep building that organic brand, I think we're, I think we're positioned really well.
Okay, Maida, Red Point's edge to round us out here.
Yeah, I think, look, my point of view is we have I think we provide something unique. I think a lot of things that I and other people say may sound similar. The most important data point, in my opinion, is what is to what Henri said earlier, like what's the relationship what is the feeling you get when you spend time with this person? Do you feel like they're in your corner? Do you feel like their portfolio and point of view align with your own? It's a really long journey when you sign up to work with an investor and vice versa when we sign up to work with a founder. And that qualitative piece is so important. And the other thing I say to founders is I think we are the best partner for a lot of founders, but not all of them. Like, I don't know anything about clean tech. I will tell you that up front. Like, I'm not going to be the best partner for you. And I would love to help you find that person. And it's probably not me, given my background, and also the way Redpoint's set up to support our founders. I think the things that we talk about at Redpoint are, we've been around for 25 years, and a lot of the things Nimi said are probably similar here. We've, on the early stage team, have systematically built a team that is all former founders and operators, because we do think I think for us, the most important thing is the relationship with our founders and how we support them. And that empathy, I think, is different when you've been in the trenches before. And, so that's the number one thing that we're trying to do. And we have an amazing founder experience team, which is our version of a platform team that's aligned around 4 pillars that we think are the most important to get our companies from 0 to 1. And it's go-to-market help, customer intros, executive recruiting, and PR and marketing. And we have amazing people dedicated to each of those pillars to systematically help our companies. But I think that and a bunch of other things, while very important, come second to the relationship. And so the most important thing I encourage you to do, and I'm surprised more founders don't ask, is to do investor references, and ask not only in the success case, like Stripe, the founders of Stripe, Twilio, Zendesk, all these companies are going to say amazing things about Redpoint, but also ask to talk to founders where it didn't work out, where they didn't return our capital. And I think, you know, that's something we do is we offer up those references of, you know, hopefully it's an upside scenario, but in the more likely outcome, which is that it's not a, you know, a multi-billion-dollar company. What was it like to work with this investor? Did they do right by you? We offer that proactively often because we think it's important to show. I think almost every one of our founders, if not everyone, would say really positive things about how we treated them, and what the relationship was like and how we supported them. And I think knowing that is really important too. So I'd encourage you to, if you, once you're further along in the funnel, to ask for those references.
All righty. Thank you, panelists. I would be remiss if I didn't also answer Malay's question. Malay, for X1's part, you know, we are specifically designed to back people out of university context, just like you. And uniquely, with one slug of equity from X Fund, you will get the resources of two of the world's very best venture firms, Excel plus NEA plus Briar Capital, and some of the world's very best universities. And so we welcome all of you, as I'm sure all of the panelists do, to reach out. And on that, I will wish you a wonderful rest of your day. Thank you for spending this hour with us.